Have you ever wondered, what in the world is market capitalization? And do I even have to be concerned about that? If you've asked that question, stay tuned. I have some answers for you. When we talk about market capitalization, I know there's a lot of information out there on the internet. There's other videos you can watch. There's articles that you can read. I just wanted to go ahead and make my own video and throw it into the mix and see if you might find this helpful. When a company decides it wants to go public, let's say we get together, we form a company, and we're pretty successful at that company, but we're getting to the point where we want to expand. We need to raise some money in order to do that. Well, one way may be by selling bonds. Maybe we haven't been around all that long, so people don't know all that much about us. And they may not be willing to loan us money in order to expand. So another thing that we may decide to do is sell part of our company to the public. This is known as an initial public offering, or IPO. A lot of people have a real interest in these things. They get all excited when a new company is getting ready to go public, which is what we call this. They really wish that they could get in because they see a stock that they could have bought for 30 suddenly shoot to 400. Well, that was largely during the dot-com phase. Other people say, no, I want to let this company trade for a little while first and just see if it's really living up to what I think it should live up to. I want it to be more established. A company gets together. They decide they want to make shares available to investors. An investment bank will come in and help to determine what is that company's value. You may ask your accountants, you may ask other people, you may have a figure in your head. Until somebody comes in and looks over the entire business, you don't really have a good idea of what that value is. How many shares are we going to offer? 1,000? 1,000,000? 1 billion? An investment bank will help you to determine the number of shares that you will actually make available to the public. Then what is the price going to be? Somewhere along the line, you need to come up with a value for that company, and the investment bank will do this. Through an active division, you come up with a share price. Here's an example using multiplication. Let's say that a company is valued at 100 million, and your company decides that you want to make 10 million shares available to the public, and you want those shares to be $10 each. The initial market capitalization, or market cap, for your company is $100 million. Once it goes public, then it enters into the stock market. And that is called the secondary market. And most stocks that we invest in, we don't own them. We didn't start them before they became public. We can go using a brokerage account and buy shares of these different stocks. And this is the secondary market. After a company has an initial public offering, the shares are then traded publicly in the stock market. Prices are determined by supply and demand. If there's a lot of supply and not many buyers, the price will go down. If there's a real demand and you're running out of shares, price will go up. As the stock price increases or decreases, the market cap is determined. A lot of the really big companies, they started out as really small companies and then just grew over time to become a lot of the companies that we've heard of every day. The market capitalization is the total dollar value of a company. Notice that I said it's not the real value of a company. It's what the market thinks the value of that company is. You figure out the market cap by taking the number of outstanding shares and multiplying that by the price of a share. Some definitions to be aware of. If you're really big, the really big companies like Apple, Amazon, Microsoft, they are in the mega cap category. These are companies that have a valuation of 200 billion or more. Then we have the large cap stocks. These are a lot of stocks that you probably have heard of, although there are a lot of really big companies out there that maybe you've never heard of before. Their value is anywhere from 10 billion up to 200 billion. Some of the indexes that we use for the mega and large cap stocks are the Dow Jones Industrial Average, or DJX, the S&P 500, or the SPX, and the NASDAQ 100, or the NDX. We also look at the mid-cap stocks as well These have a value of between 2 billion and 10 billion. And an index that is used to track those is the mid-caps. Standard & Poor's has an index that just tracks mid-cap stocks. We also have small-cap stocks. These are valued anywhere from 300 million up to 2 billion. And there are a couple of different indexes that we can look at for that. One is the Russell 2000, which doesn't seem to be as popular as it used to be. I look at another index called the Small Cap Index put out by Standard & Poor's. We also have another group of stocks for these little baby companies, which, looking at their prices, you may not think they're little babies, but compared to other companies, they are. We have micro cap stocks anywhere from 50 million up to 300 million. And then nano cap stocks are any stocks that are below $50 million in value. Why is market capitalization important? And I didn't want to get really deep into all this. I just wanted to hit some high-level points. People prefer, especially Americans, we like to base things on size. We think that size matters. Bigger is better. And so if it's a really big company, we feel a lot safer with that big company. People like to compete. This is a capitalist system, at least for a little while longer. You want to compare one thing with another thing. Large companies are thought to be less risky than smaller companies. Larger companies have typically been around longer. They have more of a track record. They have products that you may know about or even use. They might have services that benefit you. So you know something about that company. Where smaller companies, maybe you've never heard of them before and you don't know much about them. Some investors like to diversify based on size. They like to have some really good quality stocks, or what we call blue chip stocks, in the large cap or even mega cap arena. Then they might have a part of their portfolio in the mid caps, and then maybe another part of their portfolio in the small caps, or even into some of the micro or nano cap stocks. Each investor is going to be a little bit different. The idea is to diversify and not have all of your eggs in one basket. Usually, more established companies can offer more stability when it comes to earnings growth as well as dividends. Those are usually the two reasons why people buy stocks. They want to see growth. They want to buy a stock at 10 and sell it at 20. Or they may buy a stock at 10 and they don't care if it goes to 20 or not. There's a really nice dividend that they get by investing in that company. Smaller companies can offer greater growth potential. At least that's the idea. A lot of smaller companies may just start out with one or two products or one or two services, and then they expand into other areas. And as they grow, they take on more customers, their earnings grow, maybe their dividends grow, and the price of their stock also goes up in value. Most investors tend to have a perception. The first perception that we look at is risk versus reward. The general idea is that the bigger the stock, the less the risk. So the risk will increase as you get into smaller companies. And there's some logic behind that. We've seen over the course of time where there are some very big companies that have become risky, and there are some small companies that have been very stable. The other side of that is also true. The more risk you're going to take, the more reward you're going to get. And that's why a lot of investors like these smaller stocks, because they see more of a reward potential. Or if you invest in the boring old stocks that have been around a long time, you may not be happy with the returns you're seeing. It may not be exciting enough for you. So you want to have a bigger reward, but you're willing to take on more risk. And each investor must decide where they fit on the risk versus reward scale. Another perception is that smaller companies are more volatile than large companies, and that can be true. At the same time, there are some really big companies that really move up and really move down quickly, and there are some small stocks that don't really move at all. They're like turtles. Their price just kind of stays the same day after day after day. Another perception is that the smaller you get, the less liquidity there will be. Now, some people don't think liquidity is very important. In the program that I teach, the SPX investing program, liquidity is the number one factor. You want to be able to get in and get out quickly. A lot of investors feel, and this is true to a large degree, where the bigger the company, the harder it will be to get in, and it may be even more hard to get out when you want to sell that stock. Where a large company, you can zip in and zip out very quickly because there's so much volume that trades each day with that company. What are some of the misconceptions about market capitalization? The first thing we need to look at is the real value or enterprise value. This is more of an educated value that they come up with. This is what a company is really worth. Not what the market says it's worth, not what the street says. This is what numbers say that company is worth. But beware, those numbers can be wrong, and those numbers can change, and those numbers can be manipulated. We're looking at information that may not give us the whole picture. Market cap is what investors determine to be the value of a company. What is it really worth? They use a thing called fundamental analysis, and I have another video that goes a little bit more into depth on that, where it tries to determine the real value. You have people that love to work with spreadsheets. They like to do research. They like to read about a company. They like to study the management, study the products, study what they have in development, and then come up with what they think that stock is worth. And then they go out and they look at the current price and they go, based on my calculations, that stock should be at $40 a share. I look at the current price right now, it's at $30 per share. That's inexpensive. I'm going to buy it. So you buy that and you hang on to it for a period of time. Maybe it gets all the way up to 60 and you re-crunch your numbers again and you think, based on my calculations, this stock should only be worth $55 per share and it's selling at 60. I'm going to sell. It is an expensive stock. And that's really what a fundamental analysis type of approach will use to make decisions. Wall Street is full of these people. Most analysts are fundamental analysts. Most of the guests that you see on the financial channels are of the fundamental analysis school of thought. If a company is purchased by another company, the price may be different than the market price. Especially when the market's really going up, we see a real increase in activity in mergers and acquisitions, M&A. You may own a stock and it's worth $40 a share. All of a sudden you wake up one day and you notice that stock is trading at $50 a share. What happened? Well, maybe another company decided to try to buy the company that you own, and even though it's trading at $40, they're willing to offer $50 per share. You just saw a $10 per share jump. Do you stay in? Do you get out? You will have to determine that. Investors out there look for these opportunities. There are newsletters that you can subscribe to, and they're looking at different companies thinking, this one is likely to be bought by another company. Let's go ahead and invest in that with the idea that it will be offered a much higher price than what the street is paying right now. And a lot of people have made a lot of money doing that. Any company can vary in their price. We see really big companies with lower stock prices. There was a time when you could get Apple for $7 a share. Believe it or not. There's other companies that were trading at $200 or $300 a share that don't even exist anymore. They were .com busts. Started off really well, and everybody was flying high, but they didn't have any earnings behind those companies, so they fell down to zero. Risk. There can be risk in large companies. What if a rock star CEO dies or gets sick or says that that person is going to retire and they're really the backbone of what has happened in that company? That could be a real risky thing. There's other companies, they're smaller, but they might have a really established management team that is really moral and really works hard to be a good, solid company, but their price isn't all that high. We can also have differences in volatility. One of the things about small stocks is they don't have as much volume, and there may be a big difference between the bid and the ask spread. And I have another video that talks about the bid-ask spread, if you want to look more into that. The idea that most investors want is they want the bid-ask spread to be very small. So the price that you buy, and if you were to immediately turn around and sell that, they would be at about the same price. Where if you get a stock that doesn't trade very much, there could be a real big difference between what you would pay to buy and what you would get if you sell. This can produce what looks like volatility. On the other hand, there are other stocks that are heavily traded that move a lot. You have a lot of people that are short-term traders. They're looking to get in, make a small profit, and get out. And that can really produce an EKG-looking type of chart. Since people like to know what is the biggest, this is a list that I found as of the end of 2020. There was one time when Exxon was on this list. It's not even here now. As times change, as the economy changes, as we shift from one part of the business cycle to another, these companies will jockey around in different positions. But right now, at the end of 2020, Apple was number one. A lot of these other companies are from other countries, and you may not have heard of them. The number 2 company, Microsoft, used to be number 1. Now it was number 3. Amazon, Alphabet, which we know better as Google. Probably a lot of these names, Tesla, Facebook. You may have heard of Alibaba. Some of them are located in different countries. There's Berkshire Hathaway. That's where Warren Buffett does his thing. Samsung, Visa, JP Morgan, Johnson & Johnson, Walmart. I don't even know how to say number 17. Procter & Gamble, United Health, Nestle. Hey, you want some chocolate? Yeah. I went to a site called thebalance.com. If you just Google this, you'll come up with a list. And this changes pretty much every day. Every day the market is open, the prices for their shares fluctuates. And so they're going to come up with different values. And if they go through a difficult time, they may drop down on the list. Or if they have really good times, they may get bumped up on the list. Thank you very much for taking the time to watch this video. I really appreciate that. If desired, please click on the like or the dislike button below. That would really help things out. Please leave me any comments. If you have any feedback, something I missed, something that you liked, something you didn't like, please feel free to let me know. Also, consider subscribing to this channel. That'll really help things out too, by clicking on the bell to be notified when new videos are posted. So with that note, thank you very much for watching this, and I'll see you in the next video.